Good evening, everyone. Time for another silver update. So we're looking at the 2-hour chart of silver, and I've drawn some new trend lines in since the last time I drew this downtrend line on this pennant that was forming inside of this this other formation. So we broke out of that pennant and we penetrated this upper downtrend line. So we're kind of indecisive right now on this upper downtrend line. We're basically sitting at the price. So could bounce off it or could just come right up and go through. The next big price is that 32.50 high, and I've covered that many times before. That's probably the launch pad if we're going to have that sort of a move. So the big news today is interest rates. So I was telling you on the charts that I've been covering on the interest rate charts that they were looking, I think the last time I showed you was the daily, I think. And I pointed out that the 2-year note daily chart was indicating weakness. When I saw it test this band and fail, bounce off this, and then halfway starting to roll over, saw it coming down by the line, started to think, okay, it looks like we're going to get a penetration to the downside, and that could leave pretty significant room to run. Now again, this is the rate. This is not the price of the 2-year note. This is a rate. You can see 4.517. But the breakdown happened right there at 4.6. That's where it sliced through. And yeah. So that's a 2-year. Now looking at the 10-year, well, let's look at the 1-year. Rolling over, I don't have any trend lines drawn in, but rolling over not as significantly as the 2-year. And then we want to look at the TNX, that's the 10-year note, 4.2% basically. So same sort of pattern here. You can see it was, this is maybe even a longer, my trend lines are kind of a mess, sorry about that. I've got too many of them in here. Can probably eliminate some, but this trend line goes back, where does it go to? Right here. So it has some touch points, not a lot, but we did cut through it. That's the main thing. We got through it, and that's an indication there could be quite a bit more downside. So that's the 10-year. Then, of course, the shortest maturity is the 1 month. They're U.S. Does it say U.S. 1 month? Yeah, 1 month government bond. So that is the Fed yield that's set. Could call it, it's not the federal funds rate, but it's close enough. So that has not changed. So I want to take you to a historical chart of the S&P 500 and the U.S. federal funds rate. So we might not, hopefully we could zoom in close enough. I don't know if it's going to let us zoom as much as I want to zoom. Apparently not. But the main question is going to be what's going to happen if this is the beginning of a rate cutting cycle. So we're starting to hear the noise, and we're also starting to see the signs. We're starting to see some bad numbers in bankruptcies. They're hiding the numbers, but we're seeing some bad numbers in unemployment. Prices are falling, even though we know those are fake, but they're reporting falling prices. And the big question is, if we're, going to be in that bear market sort of reaction, when does that come? So just looking historically, probably the best historical one we want to look at would be the Great Financial Crisis, or the Great Recession, whatever you want to call it, that happened in 2008. So you can see we had a flat top here in rates. Now, that flat top in rates was roughly where we are right now. I think it was a little lower than where we are right now. But you can see it lasted roughly as long as we had, and then they started cutting. So you've got 1, 2, maybe 3 cuts, and the stock market has not turned down. And then when we started to get more cuts, then that's when stocks turned down. So the traditional saying with stocks is 3 steps and a stumble. And that was, if the Fed raises rates then 3 times, then you're going to get a correction in the stock market. That's not a good rule. You can see in this instance, there were many, many increases in rates. Then they held flat. Then when they started cutting, that's when you got the stumble. We also have an example with the minor recession that's listed there for the COVID thing. But you can see that the rates started significantly before that. Rates started going down in May of 2019, all the way through the year 2019, and then it wasn't until COVID that we got the stock market correct below its old low, and we got a recession, a mini recession, and this is all fake because it's by government decree, but nevertheless it's on the chart. And then we've got the 1987 crashes in here. There's no recession with it, but you can see that the Fed cut, and then was raising, and they didn't cut until after that one. So that's an instance where rates were kind of drifting. I think there was something that happened with the currency. I think something happened with the dollar. So it's not a hard and fast rule. And you can see in the early 80s, when we had the big spike in rates, you can see we got up to about 18%. That gold and silver topped here in 79, 80, and we had a brief recession when that happened. We kind of had a recovery. Rates spiked up again and again. That brought on the 1982 recession. And in that instance, they really didn't start cutting rates until the recession started. And they continued cutting all the way through the recession. Finally, the recession ended. So it's hit and miss. You have historical examples where the Fed, the stock market turned down, and then the Fed started cutting rates. And you have instances where the Fed started cutting rates, and then the stock market turned down. But rate cuts are definitely associated with the downturn in the stock market. So we looked at the interest rate markets, and it's very significant that the 2-year and the 10-year are rolling over and cutting through underlying support. So the question is what about stocks? Now, when we take a look at the S&P 500, this is on the 2-hour. We don't really get anything. Nothing of significance. Looking at the weekly, the only thing we can say about the weekly is that it's overextended. You can see it's definitely the indicator's overbought. The price is extended above 2 different trend lines, kind of way out of whack. But really, the old trend line is all the way down here, and the last time we had the COVID low, we got a rally way above that trend line, so that doesn't mean we can't go higher. So we're not really seeing a rolling over in the S&P 500. Now the NASDAQ is going to be a little bit closer to the big leaders, and we do have kind of a red candle. We don't really have anything else except for the fact that we have these this fanning upward motion indicating parabolic movement, but we don't have anything, or do we have? That's the question. Do we have something? So I'm going to take you back to the Bible of investing, Reminiscences of a Stock Operator, and read a section there about Jesse Livermore trading the beginning of that bear market. But I want to take a look real quick at some of the leaders, because that's what he's going to address in this. So we want to look at Apple. Now, I don't have NVIDIA on here. It won't let me add any more symbols. But so we want to look at Apple. And Apple still looks pretty bullish, even though it's kind of a runaway. So I don't really see anything happening in Apple. That's one of the big leaders. Now, I believe NVIDIA had a big correction, and so that may be one that's already starting to roll over. We have Google. Again, nothing that you could really say yet. I mean, we're on the weekly. I guess if we go back to the daily. So looking kind of correction like toppy, but nothing substantial enough to say we've got to change in direction. We'll see that when we look at Livermore. So Microsoft, well, yeah, definitely overbought, definitely looking toppy, but is this the big rollover? If you bet like that, you can bet a lot and be wrong a lot, and it can cost you a lot of money. Last one I want to look at before we read is the Russell 2000. So the Russell 2000 is a small cap index, and pulling it out to the weekly, it doesn't have the kind of percentage advances that the other indices have, although it's pretty good. I mean, we had a low of about 350, and a high of 2,400. So that's a pretty good percentage return for 4 years. Wait, no. Oh, that's the low in the last recession. So yeah, that's a 15-year period. And it's a move of, what is that, 6 or 7-fold? I'm not going to do the math. So let's jump over to Livermore, and we're getting a story here of when Livermore was trading the World War I bull market, I believe. Don't quote me on that. I don't remember the dates of World War I. Anyway, he's trading a bull market, and he's trying to teach us how you can recognize a bear market starting. And he does not talk about interest rates, although he mentions a war bride, which indicates that, there's inflation that is accompanying the war. But so he's going to describe here how you can kind of recognize a bear market starting. And his system, which is so unique and so amazing, the system automatically put him short into the bear market. You didn't even have to really pick a top. So we'll read this and you'll see. I went along with the rise in 1916. I was as bullish as the next man, but of course I kept my eyes open. I knew, as everybody did, that there must be an end, and I was on the watch for warning signals. I wasn't particularly interested in guessing from which quarter the tip would come, and so I didn't stare at just one spot. I was not, and I never have felt that I was, wedded indissolubly to one or the other side of the market. That a bull market has added to my bank account or a bear market has been particularly generous, I do not consider sufficient reason for sticking to the bull or the bear side after I received the get out warning. A man does not swear eternal allegiance to either the bull or the bear side. His concern lies with being right. And there's another thing to remember, and that is that a market does not culminate in one grand blaze of glory. Neither does it end with a sudden reversal of form. A market can and often does cease to be a bull market long before prices generally begin to break. My long expected warning came to me when I noticed that one after another, those stocks which had been the leaders, keep that in mind, okay? Microsoft, NVIDIA, Apple, Netflix, Tesla, Google, Amazon. The stocks which had been the leaders of the market reacted several points from the top, and for the first time in many months did not come back. Their race evidently was run, and that clearly necessitated a change in my trading tactics. It was simple enough in a bull market. The trend of prices, of course, is decidedly and definitely upward. Therefore, whenever a stock goes against a general trend, you're justified in assuming there's something wrong with that particular stock. It is enough for the experienced trader to perceive that something is wrong. He must not expect the tape to become a lecturer. His job is to listen for it to say, "Get out," and not wait for it to submit a legal brief for approval. As I said before, I noticed that stocks, which had been the leaders of the wonderful advance, had ceased to advance. They dropped 6 or 7 points and stayed there. I think you could probably translate that to 6 or 7 percentage points. At the same time, the rest of the market kept on advancing under new standard bearers. Since nothing wrong had developed with the companies themselves, the reason had to be sought elsewhere. Those stocks had gone with the current for months. When they ceased to do so, though the bull side was still running strong, it meant that for those particular stocks, the bull market was over. For the rest of the list, the tendency was still decidedly upward. There was no need to be perplexed into inactivity, for there were really no cross currents. I did not turn bearish on the market then because the tape didn't tell me to do so. The end of the bull market had not come, though it was within hailing distance. Pending its arrival, there was still bull money to be made. Such being the case, I merely turned bearish on the stocks which had stopped advancing, and as the rest of the market had rising power behind it, I both bought and sold. The leaders that had ceased to lead, I sold. I put out a short line of 5,000 shares in each of them, and I went long the new leaders. The stocks I was short of didn't do much, but my long stocks kept rising. When finally these in turn ceased to advance, I sold them out and went short 5,000 shares of each. By this time, I was more bearish than bullish, because obviously the next big money was going to be made on the downside. While I felt certain that the bear market had really begun before the bull market had really ended, I knew the time for being a rampant bear was not yet. There was no sense in being more royalist than the king, or I think they say more Catholic than the Pope, especially in being too soon. The tape merely said that patrolling parties from the main bear army had dashed by. Time to get ready. I kept on both buying and selling until after about a month's trading, I had out a short line of 60,000 shares, 5,000 shares each in a dozen different stocks, which earlier in the year had been the public's favorites, but they had been the leaders of the great bull market. Because they had been the leaders of the great bull market, it was not a very heavy line, but don't forget that neither was the market definitely bearish. Then one day the entire market became quite weak and prices of all stocks began to fall. When I had a profit of at least 4 points in each and every one of the 12 stocks that I was short of, I knew I was right. The tape told me it was now safe to be bearish, so I promptly doubled up. I held my position. I was short of stocks in a market that was now plainly a bear market. There wasn't any need for me to push things along. The market was bound to go my way, and knowing that, I could afford to wait. After I doubled up, I didn't make another trade for a long tune. About 7 weeks after I put out my full line, we had the famous leak, and stocks broke badly. So we don't know here. He just tells us that after he had put out his full line, we don't know if those 12,000 or whatever it was, 120,000 shares was his full line. He might have doubled up again. But anyway, after about 7 weeks, I put out my full line. After I put out my full line, we had the famous leak, and stocks broke badly. It was said that somebody had advanced news from Washington and that President Wilson was going to issue a message that would bring back the dove of peace to Europe in a hurry. Of course, the war bride boom was started and kept up by the World War, and peace was a bare item. When one of the cleverest traders on the floor was accused of profiting by advanced information, he simply said he had sold stocks, not on any news, but because he considered that the bull market was overripe. I myself had doubled my line of short 7 weeks before. On the news, the market broke badly, and I naturally covered. It was the only play possible. When something happens on which you did not count when you made your plan, it behooves you to utilize the opportunity that a kindly fate offers you. For one thing, on a bad break like that, you have a big market, one that you can turn around in, and that is the time to turn your paper profits into real money. even in a bear market, a man cannot always cover 100, and so it was only 120,000 he was short, cover 120,000 shares of stock without putting up the price on himself. He must wait for the market that will allow him to buy that much at no damage to his profit as it stands him on paper. So it's kind of interesting. That's all I'm going to read about this, just to point out about the leaders rolling over. But so he mentions here how much he made. He says, I cleared about $3 million in 1916. Oh, by being bullish as long as a bull market. He didn't say how much he made on his shorts. But if he was short 120,000 shares of stock and he made an average of 8 points in each of those stocks, and he told us that he didn't double them until he was in the green by 4 points. So he could have made 10 points in those stocks, he would have made $1 million. He could have made 20 points, that break, then he would have made $2 or $3 million. So it looks like he made $3 million on the way up, $3 million on the way down, probably. And that's 1916 dollars. So you tell me how much money that is today. It's a lot of money. $6 million in 1916. So why do I point all this out? Because we're starting to see rates. I think this break in rates, remember that the 2-year is the leader of the rates. So the 2-year leads the rates. That's the market voting on the direction of interest rates. And the 10-year generally follows the 2-year. And mostly connected to the 10-year is the 30-year mortgage rate. It's not connected to the 30-year bond rate, but more the 10-year note rate. We can see definitely turning down. So are we to the point where stocks are going to turn down? We need, if past history is a guide, in the situations where rate cuts precipitate the decline, then we would expect to see the Fed starting to cut before we get the significant decline. And that's always going to show up in that short-term U.S. monthly. So we're going to see some official rate cuts before the serious decline, although that's not always the case. So we can't say for sure. So what's the upshot for silver? Well, everything looks bullish unless we get that precipitous decline in stocks. So if you remember, in the Great Recession in 2008, we'll just pull up the S&P 500. I remember that because it bottomed at 666. So that's yeah, that's one that stands out. So yeah, is this percentages? I think I'm on percentages. So yeah, 666, the S&P 500, up to almost 6,000. Yeah, that is a huge run. So in the last one, we got rates rising, and then the stock market fell off. And we got about a correction from that 1,500 to 666. So maybe a 60-70% bear market. Now, if we get that, you have to remember that that is a deflationary situation, and people can be convinced that they're fighting through a deflation. So if the 2008 financial crisis is any guide, you can see silver hit 21 and it hit a low of basically $9. So silver got at least a 60% decline in the face of a massive financial crisis and bankruptcies and things like that. So that is possible. 2008 was an absolutely fantastic buying opportunity for silver. 2020 was a fantastic buying opportunity in silver. You can see you didn't have much time to do it. We're looking at the weekly chart, and you've really only got 2 weeks and maybe even days, because 1 week was a candle that went from $15 down to 11 or 12, and then the next week we go all the way up to $15. Yeah, so it can literally be just days for you to catch a bottom. Hopefully we can see 2020 on here. So yeah, on the daily chart during the COVID low, you can see we had a day where we dropped from $15 down to maybe 12. Yeah, I mean it went down to that 12. It was just in one day. The next day it traded above that. We had one more day where we traded between $13 and $11.75, under 12, and then that was the end of it. There was only like 4 days you could buy the COVID bottom. And I told you before that I remember it was a Sunday night in 2008, so how many days did we have in 2008? Now remember, this is fall of 2008. This is where companies are going bankrupt. During that fall, we had company after company going bankrupt. I don't remember all the companies, but there was not just banks. There was GM and all kinds of companies going bankrupt. So you had a lot of days under $10 and quite a few days around $9. There was a lot of opportunities to buy. I mean, compared to the last one. But that's not a lot in the long run. So we could get one of those. And if we do, then it's anywhere from 40 to 60%. That's, anywhere from $18 down to say $15, $16. And then that chance is over. Do I think that one's going to happen? No, I don't think that one's going to happen. This formation that we have here looks pretty solid. If we draw in a trend line on the indicator is trending down. The market is trending up. Is that a bullish divergence? I'm not good on divergences, you tell me. So to sum it all up, it looks like interest rates are getting ready to go down in a cutting cycle. The Fed will have to follow if the market leads. That could lead to a drop in stocks, and it looks like it's indicating a rally in silver and gold. We're just going to wait and see and keep pointing out the exact touch points and just kind of guess where to stack. And we'll talk to you next time.